Welcome back to the Noob Selling Options channel for a brand new explainer. Today we're looking at a setup that is absolutely tearing through institutional trading desks. We're talking about a massive, high-stakes arbitrage play hidden right in plain sight. And it revolves around a company called IREN. If you think this is just another crypto stock, you are missing out on one of the most aggressive infrastructure transformations happening in the market right now.
To really wrap our heads around the sheer scale of this, we've got to follow the smart money. Specifically, what exactly does a 24-year-old hedge fund prodigy managing billions of dollars see in what most retail investors just write off as a super volatile crypto miner? Okay, let's dive into this, because the answer is going to completely change how you look at the entire AI hardware boom.
So here's our roadmap for today's explainer. We'll map out the AI power pivot, run this trade through the Peter Lynch playbook, dive into the institutional valuation math, figure out the market discount, and finally, look at the execution ultimatum.
All right, Section 1, the AI power pivot. IREN is fundamentally shifting its core identity, and honestly, that's the bedrock of this whole trade. There's this massive disconnect right now between what retail investors see and what the big institutions are quietly buying up. The old legacy view, just a pure-play Bitcoin miner violently tied to crypto cycles, but the reality of IREN today, they are morphing into this hyper-growth AI neocloud. We're talking a staggering 5-gigawatt physical power pipeline and vertically integrated data centers. They are hoarding the absolute most critical thing AI needs right now, raw electricity.
And that massive hoard of power is exactly why Leopold Aschenbrenner, the former OpenAI researcher turned hedge fund manager, has built this massive conviction thesis around IREN. Through his fund, Situational Awareness LP, he's scooped up 11.7 million shares that represents roughly a $456 million equity position. He's not just betting on Bitcoin here. No, he's making a structural arbitrage play. He is betting that the ultimate bottleneck in this AI boom isn't the software, it's the physical data centers and the actual power grids.
Moving on to Section 2, the Peter Lynch playbook.
Now, what's really interesting about this setup is when you look at it through a classic investing lens. Think Peter Lynch, buying companies he understood, focusing on hidden assets and structural growth. Notice how perfectly IREN fits into his turnaround to fast grower category. Because the market still prices it like a volatile miner, early investors get to buy a high-performance computing giant at a steep discount. Even more importantly, this is the ultimate pick and shovel story. You aren't buying the AI model, you're buying the raw juice, the megawatts. And while that hefty $3.6 billion debt load actually passes the test since it's directly backed by revenue-generating hardware, Lynch would definitely wave a warning flag at their history of share dilution. That is something to watch closely.
But why IREN specifically? Well, building a brand new AI data center from scratch takes 3 to 5 years and burns a ridiculous amount of capital. But by repurposing their existing mining infrastructure for AI compute, IREN can do it 60 to 70% cheaper and in a fraction of the time. They are literally capitalizing on deeply scarce, already connected grid megawatts. That right there, that's their physical moat.
All right, Section 3, the valuation math.
Listen, if you're trying to use a standard PE ratio on a company going through a massive capital expansion, you're just doing it wrong. You have to look at their contracted future. IREN isn't just sitting around hoping for clients. They recently locked in a monumental multi-year agreement with Microsoft valued at $9.7 billion to scale up their GPU cloud infrastructure. Toss in a $3.4 billion internal research deal with NVIDIA, and yeah, they have serious, undeniable enterprise validation. Since standard metrics kind of fall apart here, institutional desks are running sum of the parts, or SOTP valuations. Basically, they slice the company into 3 physical asset layers. First, the AI cloud and that massive GPU fleet, valued between $10.5 and $13.5 billion. Second, the legacy Bitcoin mining cash cow, adding roughly $1 billion. And third, the secret weapon, their 5-gigawatt power portfolio, valued at $5 to $7.5 billion, based purely on the hard replacement cost of those grid interconnections. Add all that up, the intrinsic value ranges from a super conservative $16.3 billion all the way up to $22.2 billion.
And this brilliantly illustrates the massive disconnect the smart money is exploiting right now. Their current market cap of roughly $14.7 billion is sitting completely below the absolute worst-case conservative floor value of their hard physical assets. The market is essentially giving you their future growth for free.
Let's look at this through another institutional metric, the forward AR multiple. The story is exactly the same. Management is targeting $3.7 billion in annual recurring revenue by late 2026, driven by their goal to deploy a massive 150,000 GPUs. At today's market cap, that prices the company at a 4x forward AR multiple. For some context, pure-play AI hyperscalers usually trade at 6x to 10x ARR. So, on paper, this stock is sitting in deeply undervalued territory.
Which brings us to Section 4, decoding the market discount. So the obvious question pops up, right? Any veteran trader knows Wall Street doesn't just hand out 30% discounts on fundamentally sound, high-growth tech infrastructure out of the goodness of their hearts. There's always a catch. So why is the market treating this like a highly volatile crypto stock rather than a premium utility?
Well, it comes down to three major uncertainties Wall Street is aggressively pricing in right now. First, the execution gap. That $3.7 billion in ARR. Right now, a huge chunk of it is just contracted backlog, not active cash flowing in. The market is penalizing them until those data centers are actually plugged in and humming. Second, the capital expense choke. Buying NVIDIA GPUs and building data centers burns through massive piles of cash, which terrifies investors who worry IREN will just issue more convertible notes and dilute the stock. And third, high beta. IREN doesn't exist in a vacuum. If Bitcoin tanks or big tech hints at slowing down AI spending, IREN gets violently dragged down right alongside them.
Let's see how this builds into their overall financial health. Their balance sheet is pretty much a textbook hypergrowth infrastructure play. Short-term liquidity, super strong. They have $2.4 billion in assets, comfortably covering their short-term liabilities. But their long-term leverage is incredibly aggressive. They're carrying nearly $4 billion in debt. That means they are entirely banking on these AI contracts, scaling up fast enough to service those liabilities. It's a high-stakes race for sure.
And for the core audience of the Noob Selling Options channel, this is exactly where the real fun begins. Because of that massive capital expenditure engine and the heavy debt load, IREN trades with a whopping 4.23 beta and incredibly intense implied volatility. For option sellers, this dynamic creates an absolute prime sandbox. Their massive cash pile means they aren't going bankrupt tomorrow, but those execution risks mean the stock is going to swing wildly on macro news, and then offer some seriously juicy premiums around crucial technical support floors if you're willing to manage the risk.
Finally, Section 5, the execution ultimatum.
Everything we've talked about today, the power pipeline, the Microsoft contracts, the Peter Lynch setup, it all funnels down into one major binary risk. It's all about this critical timeline. They've already energized massive sites like Sweetwater 1 and closed a major financing package. The entire game now is hitting that late 2026 target, successfully deploying up to 150,000 GPU clusters to actually realize that $3.7 billion ARR. Believe me, Wall Street is watching the Roberts brothers like hawks. Any supply chain delays, any grid hookup lags, that forward valuation gets pushed right back and the bears take control.
So the crucial point is really captured in this quote from the research. The entire play now rests on execution. It's all about whether IREN can successfully scale its GPU fleet over the next 18 months without excessive dilution. The hard assets are there, the plan is there, but management absolutely has to cross the finish line without crushing current shareholders.
Ultimately, the smart money is looking straight past the short-term noise in the daily stock charts. They're betting that a massive global grid shortage makes IREN's physical power monopoly an undeniable premium asset in an AI-starved world. If they execute, that upside is structurally built right in.
So I really want to hear from you guys. Are you valuing a stock like IREN based on its short-term options technicals? Or are you looking ahead at those 2026 structural growth targets? Drop your take down in the comments below. If you found this explainer helpful in decoding this massive institutional setup, please hit that like button. And make sure you subscribe to the Noob Selling Options channel for more deep dive trades and fundamental breakdowns. Thanks for hanging out with me, and I'll catch you in the next explainer.